So in this video we'll look at some of the commodity markets that scalpers like to trade. Alright guys, so I've got for you 5 commodity markets that some scalpers like to trade. To be honest, there's only really a few of them here that are kind of regular scalping markets. The others are there just because I kind of want to put them there, and stick to one will be a bit of a wild card that we'll talk about in a moment. So first one, probably obvious one, crude oil. Crude oil, one of my favorite markets, up there with the DAX in terms of the ones that I like to trade. Super volatile when the conditions are right. Spreads have always been a little bit funny if you're trading via a spread betting or CFD. If you're going directly to the exchange, obviously you can get better than this. But this is for comparison. So if you're CFD trading or spread betting, both the West Texas Intermediate and the kind of Brent crude are about 3 pips, so, or 3 ticks really, because you're talking ticks, so you're not in a currency pair. So there's not a real tight spread. If you go direct to the exchange, you're obviously going to get it much better. But if we look at West Texas, for example, at the moment it's doing 200 tick range, so it's reasonable. You know, you're paying 3 ticks, you're getting 200 tick potential. It has gone up at sometimes around 250, 300 is not out of the question, $3 range. And so, you know, you kind of look at it and go, well, actually that's not too bad. If you're micro scalping, 3 pips, if you're trading via CFDs, probably maybe a bit too much. If you go directly to the exchange, a lot better. Like we talked about previously with Forex, you can't actually trade the bid and the offer, obviously, with Forex, because there isn't a kind of central exchange. But if you're trading on NYMEX and you're placing your bid and offers, worst case scenario, you're taking 1 tick spread, if you like, plus the commission, but you may well often get filled on the bid because it's reasonably liquid, it's reasonably thick. So liquidity is there with crude oil most of the time. It can get thin, it can kind of back off the throttle a little bit. A volume can be there, lots of news flow moves it, so it's a nice trader. It's one of those that comes in and out of favor. When it's really trading, it's a beautiful commodity to trade. Oil inventories comes out regularly. Politically sensitive instruments, a global economy sensitive, and it's generally kind of a good supply demand thing. You've got OPEC there as well that are trying to, you know, control that supply. So it's not a bad one to trade. You've got to find the right vehicle for it. Again, 3 pips if you're trading via CFD or spread bet might be a bit much to go crazy intraday on it, but when it's swinging, then you probably can. If it's not, then you can go direct. So that's crude oil. The next one I've got on the list for you guys is gold. Now gold has kind of come into its own a little bit. Again, these commodities go in and out, and I'm going to talk about that in a moment with number 6. But gold cash, at the moment, if you trade a cash, i.e. kind of a futures contract adjusted for cash, we talked about that a few videos back. 0.3 pips spread, or ticks spread, and you've got to be careful with gold of how your broker manages this. Now if you're trading on the exchange, of course, you just trade and you've got that 0.1 cent and you can trade based on the increment of that. But if you're trading via a spread betting or CFD broker, for example, they might say the spread is 0.3, so that's a 3 tick move effectively in the underlying market, 3 10-cent moves, and that's pretty good when you consider at the moment in time as I'm filming this. If we look at gold, the average true range of gold is around the $10 mark, so 3 cents is pretty decent. It's not bad at all. 3 or 30 cents, like, so 3.3 ticks or 30 cents, because the way even I'm kind of in my head trying to think it through, so it's worth kind of thinking about this carefully. If it's a $10 move, let's say it moves from 13.17 to 13.27, you've got a 0.3 spread. That's 0.3 of a dollar. So if you think of it like that and you can compare it to your currencies and your indices, then you can say, well, actually that's not too bad, right? 0.3 of a dollar, that's reasonable. If I get a $10 move and it's 0.3, you can deal with that. It's not too bad. Good thing about gold is a lot of people watch it. It's reasonably thick. When it gets going, it really gets going, guys. When it's in favor and it's really swinging, it's not unusual to see kind of $20 days on it and plus. And so it's one of those that you might not want to trade all the time, because $10 is okay, but not 0.3 spread is not blindingly great value here. But one thing to note is we're not always looking for great value. We're just kind of comparing, looking, okay, volume, liquidity, spread, this kind of stuff. But when things are moving, and it's moving, let's say it moves very aggressively intraday, it might move the whole of the day's range in a couple of hours, that then becomes a very nice thing to trade and a very nice trading vehicle to get involved in. And then you've got silver as well, which I haven't included. You've got palladium, platinum, copper. Those ones, again, moving in favor. But gold is kind of something that a lot of traders will trade directly on the exchange and scalp that, as is crude oil. Natural gas is another one. I put this on here because when this goes crazy, guys, this thing goes absolutely crazy. It's one of those that sits there and does nothing for years, pretty much, just years. It just sits there, does a range of kind of $6, 60 cents, or six cents, really, depending on how you look at it. Just sits there, does nothing, plods along, and all of a sudden it will just rip up and it will start doing kind of 10% moves in a day, 8% moves in a day. And so that's when it becomes quite interesting to trade. The spread is 0.3, so it's not something that you really maybe want to get involved in all the time, because if you're just sitting there doing nothing, you can't really get any meat on it. But when it's swinging, it's a beautiful market to get involved in and to scalp. So worth having on the radar if you like kind of flipping around and trading those. Corn and wheat, I'm going to bundle them together because these aren't something that you scalp intraday unless you have a direct feed to the exchange and you're trading on the order book. Liquidity is generally low, especially in the winter months. It's generally seasonal as well. I don't consider myself a soft commodity expert at all, so you go and kind of do some more research if it piques your interest. But the spreads generally, if you're not going direct, aren't that great compared to the intraday ranges. Like looking at it now, and it's almost $1 or 1 point spread, and it's moved in the day 7 points. It's horrible. So don't trade that. But the point is, I wanted to include this and wheat in news flow because, guys, when commodities like the soft commodities are hit by news flow, they are very interesting vehicles. Coffee was hit many years ago and it became something my go-to scalping day trading market for many weeks because there was a lot of volume coming in. The value was good, the volatility was high, liquidity was high. It's good. So whilst I definitely wouldn't suggest going out there and becoming a corn scalper or a wheat scalper intraday, unless of course you've got some sort of strategy that works directly in the exchange, the point is that as with all these commodities, apart from perhaps crude oil, which is reasonably volatile and has those nice moves from time to time, you need to be keeping an eye on the commodity news flow, or at least checking the charts and saying, okay, well, this really is got potential to go crazy. It's got potential to be a very good scalping instrument. And so you don't become a specialist in it, but you say, well, under certain conditions, it might offer opportunity. So I have it on my list. I kind of put some kind of alarm on it, or I scan it regularly and say, hey, you know what, the ATR is suddenly ripped up. Something's going on here. It's become a very nice volatile market intraday. There's all the attributes of a good trading vehicle. I can scalp it 10 times a day and it's not costing me a fortune. So we've gone through a few now. The previous video we talked about FX, commodity. Next one, we're going to talk about the indices. This is where you can kind of see the value difference. And again, we want to say, we're not saying you shouldn't scalp these other things, but I want to point out one of the main things is if you're scalping is your costs, you want to keep them down. So we want that tight spread, we want that commission low. We want to see it relative to how much meat we can get. And a little bit inferior, saying what's the daily range, because like I said in the previous video, yes, you could go up and down 5 times that daily range and give you much more juice on it, but it's a loose benchmark that gives you an idea whether something is volatile or not.